The federal government subsidizes a lot of things. For many, many years, the federal government has been subsidizing oil and gas investments, and that encourages economic development, encourages domestic production, so we don't have to buy oil from the bad guys. And this is really good. So a lot of our clients do this. Frankly, they do it every year. Some of our investors can minimize income tax while getting a return on their investment and participating in the oil and gas industry. Hi, this is Jim Cunningham. I have Christina Lindsay Orta from Ascent Wealth Management and Chris Spence from Mewbourne Oil Company here today to talk about a deeper dive into oil and gas. I love the title, A Deeper Dive. So, this is great. I'm Jim Cunningham. I'm an attorney over 25 years. I've been an attorney 30 years next year. We have offices throughout California. I'm a certified specialist in estate planning, trust, and probate law, as well as securities insurance licensed, a second-generation attorney, and a third-generation pilot. These are the lawyers in our law firm now. We've added a few, and it's a great team of people, really dedicated to serving high income and higher net worth people. And this is the team at Ascent Wealth Management. Definitely a lot of girl power there, which is fantastic. Christina, you're awesome. And any guarantees, look, this is a disclaimer, any guarantees, you got to talk to your individual financial professional. I'm a lawyer. I'm talking, words are coming out of my mouth. This is not legal advice. This is strictly just information, great information. And this is the Cambridge disclosure. So I will turn it over to Christina and Chris. Take it away.
Jim, I'm going to have you just pause on the Cambridge disclosure for just a moment, because I know that we're going to get some heat when we post this on YouTube if or on your website if this doesn't have a little bit more of a pause. So just want to make sure that we remind everybody that this is definitely not an offer to buy or sell securities, and every single client has to be qualified. This has to be suitable. We're not talking about any particular investment. We're just talking about generics about oil and gas investing. So thank you.
Thank you, Christina. I just was so excited to talk about this.
So I definitely wanted to make sure that we took advantage of having Chris Spence with us from Mewbourne. We've got a lot of existing repeat clients that have invested in Mewbourne on this call. So, anything again, specifically related to a particular product, we don't want to get into anything that's product related, but we do want to take advantage of his expertise in the oil and gas space, and Mewbourne being one of the private largest drillers in the US domestically. So we definitely want to be able to take advantage of picking his brain on what's happening in the oil and gas space and how oil and gas investing works in general. So starting with just kind of where Mewbourne focuses their drilling. You guys are mostly, I think we have in the next slide here, in the Permian Basin and Anadarko Basin, which I've had a chance to go visit the actual oil fields with your company, Chris, and see the operations, boots on the ground. But tell us a little bit about these basins and where you guys are drilling.
Yeah, you bet. And thank you guys for taking the time. So we actually drilled our first well in the Permian Basin, Glasscock County, Texas, in July of 1966, and then up in the Anadarko Basin in the early 70s. Since then, we've drilled over 3,200 wells in these two basins, and at this point in time, are one of the most active operators in the Permian Basin. And you can see our district offices strategically located throughout these two areas. We're headquartered over in the eastern part of the state in Tyler, Texas, which is where I live and work, and I'm calling in from today. But then our district offices are scattered throughout both the Permian and Anadarko. So you can see Midland, Hobbs, Amarillo, Perryton, Woodward, and Oklahoma City, Oklahoma. And in total, we've got about 650 employees. About 550 of those are out in these district offices. These are engineers, these are geologists, these are landmen, these are geophysicists, men and women who are tasked day in, day out with finding, developing, drilling for, producing, oil and natural gas. So we are what the industry would refer to as a boots on the ground organization.
And correct me if I'm wrong, but these are pretty much old salt beds. So this is a lot of pretty well identified areas to drill. And this has been proven wells that you guys haven't drilled any dry holes for over a decade or so, right? Mhm.
Yeah, I mean, look, these were huge sedimentary basins that there was, in fact, at some point in time, massive rivers or streams or oceans that were on them. Of course, we're talking tens of millions of years ago, and of which you've had now rock formations that have essentially laid upon them for tens of millions of years, and you basically have carbonate that you're targeting today, and when you go back and look at oil and gas developments over the course of the last, 100 and let's call it 25 years in this country, these are two of the most mature basins, but because of the lithology that's there, just because they're mature doesn't mean that they're in any way, shape, or form, quote unquote, tapped out, if you will. In fact, they've arguably, proved up more reserves over the course of the last 10 or 15 years due to horizontal drilling and hydraulic fracturing, multi-stage hydraulic fracturing, than they had produced in the 100 years, leading up to that point in time. So, in large part, what you're doing in these areas is developmental drilling, where today you're basically drilling, horizontal wells in the same areas that you would produce, vertically for generations.
And as we're talking about these particular areas, and Mewbourne being a private company, one of the few private operations that's drilling out there, how is regulation and government limitations, drilling on federal lands and land leases, how is that affecting you in particular with these regions?
Yeah, I mean, so when you're drilling wells, it's on either federal lands, state lands, or private lands, and there's very little federal in Texas. There's some in Oklahoma, and there's a fair amount in New Mexico. And so a lot of what we do in the southeastern part of the state in New Mexico is on BLM land. And so, yeah, we're quite astute, I guess, as it relates to what's been taking place at the federal level on the leasing or the permitting side specifically. There was actually an executive order that President Biden signed on his first day in office that essentially put a moratorium on the federal leasing program. That was challenged, and there was a lower circuit court, I believe, in Louisiana that overturned that. And so effectively what they've done is just kind of drag their feet. But you are able to get permits there when you need it, but it's not as robust as it was under the prior administration. On the state and private side, it's largely a non-issue. But as far as any other legislation, you learn, you grow, you adapt, and you comply is really, I guess, the easiest way to go about business. New Mexico is in the process right now, and we're actually the second largest producer in the state of New Mexico at this point in time. So we clearly have a seat at the table as far as these discussions are concerned. But they're in the process of adopting what are arguably the most strict methane emissions rules, and I would think will probably be adopted at the federal level in the not too distant future. I would think other states follow suit too, and it's being referred to as the 2% rule. And the goal here is to essentially minimize flaring off of your natural gas. That's clearly the right thing to do by the environment. It's not something that we've been in the practice of doing. We actually have always been in the practice of producing and marketing and selling our gas. But nonetheless, what this new rule is it effectively says if you produce 100 MCF of gas, you've got to show a bill of sale for 98. And there's going to be some operators that are going to struggle with that. But in our most recent audit, we were at about 99.5 or 99.6%. So we've largely been compliant with it. There's a cost associated with it, but like I said, it's the right thing to do by the environment. So, we've got a seat at the table in terms of these discussions. And like I've said, having been in business for nearly 60 years, you learn to comply with them and you move on.
Great. That's good. That's really good. Well, kind of getting into a little bit more here on oil prices. That's probably the question of the day is where are oil prices headed? It's been quite a volatile couple of years between COVID lockdowns and, limited supply and Russia. And, I think there was a period of time, if you look, what was it, 2016 to 2019, it was in that what every economist liked to say range bound. It was very range bound in that 55 to 65 kind of price point for a very long period of time. What do you guys see in the oil price industry? You know, are you guys seeing more pressure on prices? Have come down as of late, but what are you guys seeing?
Yeah, look, I think it's obviously easy to answer that question in looking in the rearview mirror, right? Because I can tell you where prices were. I don't necessarily know where prices are going, and I'd be lying to you if I said I did. I don't know whether they'll be next week or next month or next year. We can look at some different trends though with regards to activity in the business, and I think that helps to answer some questions. And you can look at some trends on the demand side, and that probably helps answer some of those questions too. But what I think is important to kind of talk about as you look at this slide, because I think it helps answer that question, is this goes back over the last 10 years. And if people recall correctly, coming out of the financial crisis of 2007, 8, 9, you had oil prices that recovered rather quickly back up to around $100 a barrel, as is illustrated in this chart. And then just in the face of lost market share, OPEC came out on, I believe it was Thanksgiving Eve of 2015, and said that they were no longer going to support prices. And effectively what happened is prices went from 110 to 26 in a relatively short period of time. And coming out of that, you had a lot of our publicly traded peers that said they were going to start adopting these capital discipline measures. For decades, a lot of these companies had essentially been rewarded by growing their reserve base at any cost. And in a lot of cases, what that meant was spending and investing well outside of their cash flow. And as prices collapsed, and in an attempt to basically, regain some level of attractiveness in the public markets, you had CEOs and CFOs and boards basically saying that we aren't going to grow the business the way we always have. In fact, we've made promises to not grow, and we're going to return value to shareholders through dividends and through stock buybacks and things like that. And the only reason I bring that up is it was at that point in time that the seeds of what is now a chronic lack of investment taking place in our industry were initially planted. And you can see that prices never really recovered back to above about $65. And then of course, COVID hits and they go to zero, or in fact, negative, I think 37 one day. And they rapidly recovered to where they did, this past summer as well too. But if you think there was a lack of investment taking place leading into COVID, take oil prices and send them to zero and see what happens to everyone's earnings and their budgets, and they completely fall apart. What it's effectively done now has only been compounded by this discussion as it relates to, ESG and socially responsible or impact investing, whatever people want to refer to it as. And what you have is some of the largest fund managers and largest insurers, and largest endowment funds or pension funds in the world that are adopting these ESG scores and saying, if you can't meet some threshold, you're not an investable business, and you're going to get screened out. And billions of dollars of investments have left the space. And so in an industry that is otherwise capital intensive, we're still no different than any others. I don't care if you're making mattresses. If the investment you're making in your business falls by half, you're going to produce fewer mattresses. Same is true in the oil and gas business. If your investment falls by 20 or 30 or 40%, you're going to produce less oil. There's not fewer people sleeping on mattresses, I don't think, in this world. And there's certainly not fewer people consuming oil and natural gas. And so the end, result, in theory, if you will, is you're going to find yourself in some sort of a supply squeeze. And that's a long way to answer this question, but I think it's important that people take a hard look at this chart and recognize what it really means, because there's a lot to be told here.
Yeah. Well, I think, Jim, you sent an article from, Forbes and Goldman were speaking about how, China's just in their COVID, coming out of their COVID zero policies and reopening, and between China coming back online, if you will, as a part of the consumption, and we've got sanctions continuing on Russia. Right now, with what just happened with OPEC, as you described, prices have compressed. But if there's not enough drilling and capital investment, there's probably going to be a supply issue at some point that could put pressure on prices. And I think our next slide talks about kind of like the rig count and where we're at with a supply standpoint. But I know that it seems like supply could be the real question here.
Yeah, I think that's very fair. In fact, if we read the same article, it's the analyst at at Goldman Sachs, Jeff Curry, who's kind of taken the wheel and captained a lot of the discussion leading up to what took place in pricing last year. And he was the one kind of sounding the alarm as far as just the lack of investment taking place in the business. And he still is a firm believer in that thesis. And this is a pretty good example of that. In fact, if this was dated 5 years prior, what you would have seen is that there's already a long-term downward trend from the upper left to the lower right taking place in the operating rigs in this country. This is pre-COVID. It's January of 2019. There were about 875 rigs running. Today there's 630, and that's off of a post-World War II low of I think 200 or so that we hit in the summer of 2020. But what's pretty remarkable, and again to quantify this, is if you go back to 2014, there were nearly 1,400 rigs running. So we're 60 some odd percent below that today. And yet, despite the fact that prices hit $120 last summer, we're still 15% below where they were, pre-COVID. And you can argue that this is actually flatlined and it started to roll over since the latter part of February, to the point now where we're actually starting to see some lower costs on rig rates in our most recent round of bids. So, the end result here is that production's essentially stalled out in the U.S. for the time being.
I have a question. Are these rigs bigger, or is one rig the same production as another? I mean, are they just getting bigger so you need fewer? Do you know where I'm going with that? Or are they pretty much, is this kind of like standard deviation and just across the board, they're just less, it's like standard deviation in terms of size of rig?
Yeah, right. No, it's a good question, right? You have seen technological advancements in rigs. I mean, today everything is top drive as opposed to Kelly rigs, 20, 30, 40 years ago. And you also now have walking rigs, which is somewhat fascinating because you're no longer having to rig down. If you're on a pad site, you can actually literally, when I say this, with drill pipe in stand, walk this rig over 80 or 100 feet, and you're saving hundreds of thousands of dollars by doing that. Some of it too, though, is also on the bits. The bits that are being used today are better than they were 5 years ago or 20 years ago. And so you're drilling wells faster. You're experiencing, higher rates of penetration. So it's a combination of a handful of things. But yeah, Jim, if you were to say, look, if we took the same rig today versus 8 years ago, how many wells can that rig drill today versus then? I don't know if it's 30% more, but it's more than 1 to 1. I can assure you of that.
Yeah, Michael has a question. Let me get my glasses because I can't read anything without them. Michael asks, how does the rig count drop? Are they depleted wells? Are they idled? Can they be restarted? Good question.
Yeah, it's a function of activity, right? So a drilling rig is the first piece of equipment that you need on location if you're eventually going to get a well online to production. No rig, no well. It's as simple as that, right? The reason that you see an increase or decrease in rigs is a function of activity, and it typically follows price. You would expect with higher prices, you'd expect greater investment, you would expect then greater production. And that's worked that way for 100 years. And at lower prices, you see companies scale back their operations. They typically drop rigs. And then as prices maybe bottom out and start to recover, you would then see the rig count typically start to follow suit. It's not an exact correlation. I would say that the rig count probably trails prices by anywhere, or lags prices by 3 to 6 months. But if you were to overlay price on top of this, you would see a very high correlation between the two. Of course, what we've experienced now, and if you go to the next slide, is who's actually operating, who's staying active. And this chart right here, guys, is the top 10 most active operators in the country based on rig count. And for 100 years, this would have been dominated by the oil majors, the likes of Exxon, Chevron, BP, Shell, and ConocoPhillips. And yet, what you see here, guys, in the green bar is the home team, right? You got Mewbourne Oil Company, the 4th most active oil company in the country, public or private, with only one major oil company more active than us today, and that's ConocoPhillips, running 28 rigs or 25. What is most spectacular here, though, guys, is the second most, or the most valuable oil company in the world based on market cap, ExxonMobil. Seconds to only Saudi Aramco is currently only running 18 rigs. We've had 20 rigs running before. The last time we did was in 2014. I believe Exxon had 80. So if you had any questions as into what impacts, ESG is having on the fossil fuel industry, look no further than this slide.
Yeah, and something else too is we have other webinars on solar, renewable energy. There are a lot of tax credits associated with that, and we'll get to the tax aspect of oil and gas. Something to understand is, my understanding is 95% of the energy used in the United States is from fossil fuels, and there is a federal goal of increasing that to, I believe it's 30%, which I think is a great goal. I'm not sure we're going to get there. But the point is, like, I drive a Tesla, I charge it at home. I know it's fossil fuel that's creating the electricity to power my electric car. So something important to understand, because if people say, oh, well, we shouldn't be pumping oil out of the ground, we're stuck right now. It's 95% is fossil fuel that's coming out of the ground. And this is really important, because when I drive across the San Rafael Bridge from Marin County, I might drive east. I see tankers come in. These are Chevron tankers. I don't know where they're coming from. Saudi Arabia, Venezuela, I don't know. It's maybe a bunch of countries run by bad people. And they're bringing the oil through the San Francisco Bay and pumping it into tanks for refining. So we use a lot of oil. And I think it's really good for people to understand that we all have kind of different views on things. And there is a reality that to keep the economy moving, our economy is 95% dependent on fossil fuels. So that's just my little.
That's right. Well, and also I know in Ventura County, where our main office is, Exxon, off the Ventura and Santa Barbara coast, they're still one of the top 10 funders of the teachers union, the pensions, the firefighters, all the public services, is because they're the largest taxpayer. They're also the ones funding a lot of the local services. So a lot of this is more intertwined than I think people realize. But I think the point being that even as we seek to be more energy efficient, have alternative sources of energy, we're still going to have a demand for fossil fuels. So I did want to make sure that Chris kind of spoke to a little bit of that and how Mewborn addresses the environmental concerns.
I love the cartoon, by the way.
Yeah. This was, I think this was a byproduct of the February we had 2 years ago, where the entire state of Texas nearly blacked out had it not been for some excess supply of natural gas that was able to be the stopgap between what we lost in solar and wind. That was, wow, that was an experience in and of itself. But nonetheless, yeah, look, you guys hit on a lot of really good points. I think if we look at just the macro part of that discussion, and then we can, I guess, pun intended, drill down to the Mewborn side of it. But you're exactly right. You'd be naive to say there isn't a transition taking place. And in fact, I think California was not only the earliest, has been the most active adopter of, certainly electric vehicles, but other forms of renewable energy as well too. But for the rest of the country, that hasn't necessarily been the case. And it's not because there isn't the same type of attraction to it. It's just the sun doesn't always shine in other parts of the country. The wind doesn't always blow. And we're in the infancy as far as a lot of these technologies are concerned, and they will continue to be perfected in the decades to come. But this transition, and this hits on your point, I think, Jim, is not days, weeks, or months, or years in the discussion. It's a decades-long discussion. And like you were saying as well, I think people have conveniently forgot that electricity isn't born out of thin air. It has to come from somewhere. And in a lot of cases, when someone goes home, despite the fact that they might have skipped going to the Citgo station or the Chevron station, they're charging their electric vehicle off of a grid that's fueled by natural gas. And so you're just swapping, one fossil fuel for another, let alone all the different, feedstocks and inputs that are in fabrics, or in, rubbers, or in, leathers and things like that as well too, that you're going to find in a vehicle. So there's a whole part of that discussion that is, I think, conveniently left out. But that's not to suggest yet again that we're not in the early stages of that transition. This is a great slide right here, right? Because I think that for a lot of people, the question that many of us started asking ourselves 10 or 15 years ago when Tesla delivered their first vehicle, which was in the summer of 2008, I believe, was, okay, well, what does that mean for gasoline demand? And somewhat remarkably, despite the fact that there's tens of millions of electric vehicles on the road, you've seen gasoline demand grow over the course of the last 15 years since Tesla delivered their first car. And if you look at it globally, right, in 2008, when they delivered their first vehicle, global oil demand was 85 million barrels a day. So think greater than Tesla, because they have peers, if you shall, in other parts of the world, China specifically. There's BYD and some others that are delivering just as many electric vehicles to their domestic economy and customers. Global oil demand is now 101 million barrels a day, despite the fact that you have tens of millions of electric vehicles on the road. So this isn't so much, hasn't proven out to be a discussion as far as displacement, so much as it is a discussion about, again, just a continued transition.
That's a good point. Really good point. Bless you. But I do want to make sure we talk about, bless you, the environmental concerns too, and how, like, there's been a bad rap, if you will, on fracking, and there's certainly been major offenders that took place in the Appalachian and the Pennsylvania area. But can you speak to kind of how, as a responsible oil and gas company, how you guys are dealing with environmental considerations?
Yeah, I mean, I think it's a largely misunderstood industry, and I think that's why it's important, Christina, when you had a chance to come out to the field to kind of get a better handle. It's not so much to discuss, you're an oil company, or discuss, opportunities or things like that. It's really to kind of give you a boots on the ground experience on, what it means to take an idea to fruition and then eventually to production. But more importantly, what are the various stages and the considerations that are being made from the planning and the environmental side there as well. You cannot just walk out somewhere with a backhoe and a digger and say, I'm just going to start drilling wells right here, right? Like, you actually have to apply for state approval. And in many states, they actually have a governing body that tells you exactly how it is you have to design your casing string in the most sensitive areas, basically to hold back any access to fresh water tables. And so that's kind of the first layer of consideration. And then, of course, from the perspective of the completion side of the well, or what's commonly referred to as hydraulic fracturing, that clearly was something that was picked up on back, I think, kind of the mid to late 2000s in a documentary series called Gasland. And it painted a very broad and yet inaccurate picture on our industry. And what's largely been determined post the release of that, and has largely discredited a lot of the claims, is that most of what has been identified as having any issues as far as freshwater or groundwater contamination, or specifically as it relates to seismicity, isn't a cause of hydraulic fracturing. It was actually a byproduct of injecting produced water into formations that will otherwise accept them. And that's been a common practice of the industry for generations. It just so happened that there were some bad actors that were effectively overpressurizing zones in areas that actually had existing faults, and that was basically your cause for some of your increased seismic activity. The states came in this one specific example, Oklahoma, and they just shut it down. And what did they see? Well, they saw seismic activity fall back to levels they hadn't seen in decades, otherwise considered normal activity in those parts of the country. So I think, again, speaking at it at an industry level discussion, people are actually better suited to make those decisions than I think the general public appreciates. And I think that the governing bodies do a good job of oversight there as well too. As far as Mewbourne Oil Company is concerned, I mean, I think we've always wanted to try to be a leader in this. We've been in these two basins for 50 plus years. We have hundreds of people, not to mention their families, that if we were out there knowingly contaminating and polluting the environment or fresh water, which is otherwise the backbone to these agricultural economies, we'd be shooting ourselves in the foot. There's no long game in that. And so we are constantly looking for different ways that I think we can be better stewards to the environments in which we operate. And one of the most obvious ways that we figured that out over the course of the last few years really was on the water disposal side. And this was kind of born out of that discussion as it relates to seismic activity. And what if you just don't inject produced water back into the ground? What if we can recycle and treat that and reuse it on a future job? And believe it or not, for every barrel of oil we produce about 4 barrels of water. So today, as a company, we're producing 700,000 barrels of water a day, and we are now recycling approximately 75 or 80% of that water and reusing it in future jobs, as opposed to buying a single barrel of fresh water for single use and then injecting it back down whole. So no, I think we've done a tremendous job. It's come as a sizable investment, but it was the right thing to do by the environment. It's proven to be the right thing to do by the economics as well.
And that was one of the things that I think impressed me the most when I went out to visit you guys, and see the boots on the ground operation, is just that you guys a lot of companies outsource that to other water reclamation, or they truck off the water and they just dispose of it. And it might not be in an environmentally friendly way, but the fact that you guys took the capital to invest it, make sure that you're reclaiming that water, it also ends up saving cost in the long run, about what, $1 to $2 a barrel.
Yeah, it's certainly, when you consider how much water we produce today, it's a meaningful amount.
Good. I did want to show this because I think that when I went out there to see the operation, and it's interesting, doing a due diligence with any company that I choose to work with is a big part of my job as a fiduciary, is just making sure that we're looking under the hood of people that we work with, understanding the process. But when I was out there, one of the things that was important to me and impressive was just understanding, when being in California and hearing all the environmental concerns and the negative stuff when it comes to fracking, and how you guys are drilling from the rig. When you guys are taking that initial pipe and drilling down into the earth, that initial 18-inch hole is that initial, hole you guys are drilling, but then filling it with the concrete barriers to make sure that before that drilling component that's in the very center, that really small, 2-inch diameter, I don't even know if it's that big, and the center that you guys are actually pumping oil and gas out of the earth, if you will, if anything spilled, it would hit these barriers and concrete walls before it wouldn't have any risk of contaminating underground. And besides that, you guys are drilling in areas that aren't close to any water tables or anything like that, that would contaminate the area for the general population anyway. But that was one of the things that, I don't know if I'm doing it justice in describing it, but it was impressive to me.
Yeah, like I was saying, you have to submit your well design to the governing body in the various states, and they basically sign off on it, or they say, no, you've got to actually put another 60 foot or 100 foot of casing there. So you're right. So you typically have 3 layers of steel and concrete in your most sensitive zones, which could be the first 600-800 feet of the well, where you're going to drill your initial pilot hole. You're going to then drill a smaller one inside that, which might go to the first 200 feet. That's considered your surface casing. You're going to cement that in place. You're then going to drill your intermediate string of casing and set that. That's probably going to be, maybe down to the next 400 feet. And then you've got your production string from that. And so, yeah, you've got typically 2, 3, and in some cases maybe 4 layers of steel and cement that are protecting your wellbore from any sort of water table or fresh water.
All right. So I have a question. It's more of like a comment or a thought. You're probably doing this in the middle of nowhere, so it's really hard to get to. You got to get people out there. You got to get trucks out there. You got to get 18 wheelers hauling stuff over dirt roads. You got a bunch of concrete, a bunch of steel. This must be really expensive. That's where I'm going with that. I mean, it's a well cost.
Yeah. Today, about $10.4 million, if I'm being exact.
Okay. I would, that is expensive in my book.
Yeah. Now your costs are up some from about a year ago, but yes, you're exactly right. There's a lot of people on location. There's a lot of horsepower on location. There's a lot of steel on location. And all those things have a cost associated with them. So yeah, it's your average well cost today for what we're drilling is about $10.4 million a well.
Wow.
Well, I did want to make sure that we talked about the tax benefits. So I wanted to make sure that we spoke about just what's happening in the oil and gas industry, what's happening in supply, demand, pricing, regulatory, legislative, all of that. You guys have worked through many different administrations. You guys have a good seat at the table. But why we use oil and gas investing for some of our clients, and again, it has to be the right client, it has to make sense. But just in general, not talking about any kind of particular specific investment, but in general, there's what's called the intangible drilling cost deduction for that's been in the tax code for what, 100 years, Chris?
Long time. Yep.
Long time. Where, you know, there's incentives for helping drill our natural resources here in the US, and to where you can typically get somewhere in the range of approximately 75 to 85% as a write-off of your taxes, of your highest taxed income, for making that capital investment. And so that's one tax benefit. And then you have depreciation and depletion, and the depletion allowance, essentially when you get, after taking the risk of drilling and doing the intangible drilling cost deduction and actually taking the capital intensive costs of drilling, then there's the benefits of the income stream from the production of selling that oil. And as there's royalties, you know, anyone that has had royalties from owning oil, you know, we've got clients that have had royalties for decades, you know, 30, 40 years, they still have royalties generating oil interests. But as you get royalty income, if you will, an income stream from that well, there's the depletion allowance, and that shelters 15% of the gross revenue from federal taxation on the income from that well. So anything that I missed speaking here, really, I mean, there's differences in different partnerships. If you were to look at actually investing in a specific partnership, there's an ability to invest as a general partner or a limited partner. But Chris, did you want to speak to any of the tax benefits a little bit more?
No, I mean, I think you did a very good job. You know, the one thing to consider, as you were just mentioning, is that there's an election. If you want to take the loss against non-passive sources, you've got to be at risk, which would mean you're a general partner. But by that definition, you're jointly and severally liable for all debts, losses, and liabilities of the partnership. You know, I think, you know, various sponsors, if you're looking at those types of opportunities, carry, you know, various types of protection to try to mitigate that, but that's something someone would want to be comfortable with. If you elect to be a limited partner, then you're able to take that loss against passive sources of income and don't bear the unlimited liability. There typically is a conversion period, though, where GPs would be converted to LPs and your unlimited liability is then severed. But you know, that's the certainly the risk consideration I would take as far as when you're looking at how it is that you could utilize the loss. There's no question about it.
And I think that that's one of the other intriguing things of why we do a decent amount of work with Mewbourne over the years is how you guys have taken the approach of, if someone does decide to be a general partner and take those deductions off of being active partners so that they're not limited to passive activities. How do you guys mitigate, just as a company, how do you guys mitigate that general partnership risk for any particular partnership?
Yeah, I mean, look, as far as our own personal investment, you obviously carry insurance. In our case, it's $100 million in general and excess liability. There's a separate environmental policy as well too. You know, in the case of the partnerships that we've sponsored in the past, in addition to the insurance that the partnership is then a named party to, there's an indemnification where we utilize the assets of one of our affiliates to indemnify the investor general partners to additional loss, and you of course would have the assets of the partnership as well too. So you know, again, it's a serious risk consideration, but yeah, I do think that there are a number of layers there that are properly in place to try to help mitigate that.
And then what percentage, sorry, Jim, what percentage do you guys typically take in any one well? You know, are you guys typically, if you said if it's 10.4 million a cost to drill one well, you know, total capital cost, like what's what's typically in any one given partnership or any one well that you guys are drilling, how much is Mewbourne Oil Company, whether it be through investors or the Mewbourne family, like how much percentage are you guys typically taking in any one well?
Typically it's about 60%, 60.
So, this is a great, and again, this is information. We're not making a specific recommendation, but we get a lot of people coming to us, and I know Christina, this is a common situation. The client comes in and it might be a single filer, just a single person. Oftentimes it's a married couple where both spouses are working and they're making good money. And if you have a really good paying job, we have a lot of clients, I happen to be in the Bay Area right now in Northern California. Many of our clients are working couples. They might have W-2 earnings of $1 million, $1.2 million, $1.5 million. So it's not uncommon. It's a lot of money. If that's you, know that you're getting clobbered on taxes, and it feels like more than half your income is going to taxes. So this is, I would say, one of the very few strategies that you can use that is legit. By the way, this is a legitimate strategy. This is not on the dirty dozen list at the IRS. This isn't these wacky tax planning stuff. This is solid policy for the last 100 years with federal government. And this is an opportunity where you could, for example, if you took $100,000 and you put it in this particular structure, you're able to, and you would want to meet with your tax advisor, but you might immediately adjust your withholding on your W-2, so you get more money in your pocket pretty much right away. And obviously this is like working with your A team, working with our firm, Christina, your tax advisor. If you don't have someone, we can certainly help you with that. But this is sort of mindful, meaningful planning and thoughtful investing that generates a tax benefit. And the net result is your paycheck gets a bump, every 2 weeks, or if you're paid every 2 weeks or every month, whatever it is. So this is a really good thing. If you're a W-2 earner, really works well for W-2 earners. And these deductions happen over time. So if you put 100,000 in, you're not getting 100,000 this first year. Many of our clients do 100,000 a year, 100,000 a year, 100,000 a year, 100. And I'm using 100 because the numbers are easy, right? But many of our clients do this year over year over year. And so this is something that has a benefit, not necessarily overnight, but over time. And this is what we like to tell clients is, look, people don't get rich overnight. They get rich over time. Death taxes, frankly, are optional in our country, right? Given enough time, given enough planning, most people can take that death tax bill down to zero. But again, that doesn't happen overnight. It happens over time. So these are part of the things that, the A team that I talk about. And Chris, you're an honorary A team member. If you've seen any of our videos, remember the A team from the 80s. So I don't have a cigar, so I'm not totally I'm about his age in the series, and he always seems so old, but yeah, now I'm his age. But
this is definitely one of many possible strategies, especially when we're dealing with high income earners. And I think that with California too, I think we speak to it on the next slide. Just kind of this is a K1. It also does mitigate AMT. So also in the state of California, you've got, sometimes you're subject to the AMT tax. A lot of our clients are in the 53% tax bracket. And this is just one of potentially a strategy of many that is designed to mitigate taxes. So it's not suitable for everybody. It's very much, a case by case basis, but this could be a potential way to mitigate taxes through the IDC deduction and depletion allowance.
Christina, Anita has a question. Are these tax benefits mostly federal tax advantages, or are states also given this tax advantage?
So this carries over to the state as well, especially with AMT.
Good. That's a K1. That's a lot of people are going to look at this and go, I have no idea what that is.
Yeah, this is just more of like, look, when you get into this type of complex investments, there is a K1, especially when you deal with certain types of partnerships. This is just a very basic sample of a partnership that's over a decade old, but the K1 looks the same. And there's just ways of making sure that your CPA knows how to take these deductions, should this be something that you do invest in. And I will say with K1 investments, many companies are, not obligated to get K1s out till September. Again, one of the reasons why we like working with companies like Mewbourne is that they get their K1s out very timely.
Chris, I want to thank you for that, because I say that for all the people who issue K1s, they say, well, we don't have to issue it until such and such. It's ridiculous. And that can hold up, if you're W-2 and you've over withheld, It's basically a tax-free loan to the government. So you get your refund back. And this is, again, going back to the W-2s, this is why it's really important to do tax planning. I would say if you're a very high income earning W-2 individual, you might want to make adjustments to your withholdings throughout the year, because you really don't want to overpay. I mean, I don't want to give the government money for free, because you're not, it's an interest-free loan.
Especially in California, where we're pretty much all given a free interest-free loan till October 16th with all these natural disasters. Cause we get some rain one year.
Did you see that the federal, they're like, we're going to run out of money because a lot of Californians didn't pay their quarterly tax.
Like California's on an extension to interest-free. So essentially, these are just some of the things where we would use potentially oil and gas investing, tax planning, high income earners, and this doesn't limit us to W-2. It also is business owners, or if there's a sale of a business coming, a large capital gain. So these are just potential things that we're looking for, offsetting Roth conversions or RMDs. We use a lot of clients have very hefty RMDs, and if there's a way to mitigate that, this could be another complement to their solutions. So these are the different types of things that we're screening for. But again, we are fiduciaries. We're required to act in the client's best interest, determine if it's suitable for them, and fits their overall portfolio.
Richard asks, is a general partnership working interest considered earned income, which could be contributed to a solo 401k? Interesting question.
It's considered ordinary income.
Yeah. Sorry, I was trying to wrap my head around that question.
I know.
Yeah,
I'm like,
it's ordinary income, but you do have the depletion allowance, so it's not considered earned from a qualified plan contribution.
Chris mentioned, this is another question. Chris mentioned they make 60% on a well. I think it was taking an ownership stake of 60.
Yes, correct.
Yeah, on average,
royalties to the
60% of any given well.
That's ownership of 60, not a 60% return. What percent?
That doesn't necessarily mean investors or a partnership. That just might be amongst in total.
Mewburn et al. It would be the various Mewburn entities.
Yeah.
Okay. And then the rest of the question, and I think I get the spirit of the question, so I'm going to do a little interpretation here. Is this after royalties to the landowner? What percent is distributed back to the GPs or LPs? That's kind of an interesting question. So if $1 comes in, how much is distributed? How much goes to expenses?
Yeah. So, in the United States, it's one of the few remaining countries where your surface rights and your mineral rights are actually severed. And so if you don't own the minerals, you've got to find out who does, and then you've got to essentially lease it from them if you want to, what the industry refer to as exploit it, but let's just call it produce it, right? Or develop it. And so what the standard trade has been in the oil and gas business is that we pay a lease bonus to whomever has the minerals. That could be $2,000 an acre, $20,000 an acre, whatever it might be. That's paid up front. And then there's a royalty that is then paid off of the revenue. And typically it's about a quarter, give or take now. And so for a dollar produced of gross revenue, the working interest owner gets to keep 75% of that.
Yeah. And then what are your expense ratio and what is it? I know it depends, but just generally speaking, what are you seeing as a range?
Yeah, I mean, look, in the case of our offerings, there's a carried interest where we're making a contribution to earn that carried interest. But if you look at just, again, the working interest, if you have a 10% working interest and you're burdened with a quarter royalty, then your NRI would be 7.5%. Your working interest would be 10%. So you're basically paying $1 to earn 75 cents.
Well, I think that this is one thing we also want to make sure we're discussing is there are, risks with related to oil and gas, which is also one of the reasons why we do a lot of due diligence. We choose who we want to work with. We have to make sure this is the right fit for the client. So I'd be happy to talk to any client about some of these things in greater detail. But ultimately, we just wanted to kind of spend some time on talking about how the tax benefits work, how what's going on in the oil and gas space. And if there's anything else that we didn't hit on, or if anyone wants to ask any questions, feel free. And Chris, if there's anything else that's noteworthy in the oil and gas space before we kind of wrap it up.
No, I mean, I just appreciate you guys taking the time. Feel free to follow up with any additional questions, but hope everyone has a good rest of their afternoon, and look forward to speaking with you again soon.
Well, make sure to follow us on YouTube. Thank you so much, Chris and Christina,
Yeah.
for joining us. And if there are any further questions, it looks like it's a wrap. Thanks again. And if you're watching this on YouTube, don't go anywhere, because another video is going to roll right after this one. And then you can, I'm probably going to be talking on that next one.